Listen carefully, because what I am about to tell you is something the mainstream media doesn't want you to hear. While you were celebrating the new year, something unprecedented happened in the silver market. Something that could change everything you know about precious metals. And by the end of this video, you'll understand exactly why the world's biggest banks are in an all-out war for physical silver. But before we dive into this explosive story, do me a favor. Hit that subscribe button right now. Why? Because this channel exists to expose the financial truths that powerful institutions want to keep hidden. Every subscription helps us beat the algorithm and reach more people who need to hear this information. So click subscribe, tap that notification bell, and let's get into what might be the biggest silver story of the decade. Here's what just happened. The CME Group just released delivery data that should make every investor pay attention. We're talking about massive numbers. In just the first 2 trading days of January, delivery notices were issued for over 17 million ounces of physical silver. Let me put that in perspective for you. The entire global mining industry produces roughly 800 million ounces annually. That means in 48 hours, the market moved more than 2% of the world's entire yearly production. This isn't normal trading activity. This isn't hedging. This is something far more significant. When you see this kind of volume moving in such a short time frame, you're witnessing what I call a systematic extraction event. Major players are demanding physical delivery, and they're doing it with urgency. Now, you might be asking yourself, why now? Why did this massive movement happen in the first 2 days of January? The timing isn't coincidental. There's a critical piece of the puzzle that connects everything, and it's happening in China. China recently implemented new export regulations that fundamentally restrict silver outflows. The number of licensed firms allowed to export silver has been drastically reduced. What does this mean? It means the flow of silver from east to west has essentially been choked off. The arbitrage opportunities that used to exist between Shanghai and New York are disappearing. The sophisticated institutions know this. They understand that the registered inventory sitting in COMEX vaults represents some of the last easily accessible silver in the Western world, and they're moving fast to secure it before the window closes completely. Let's talk about the inventory situation. The COMEX releases daily reports on silver stocks. There are 2 categories you need to understand. Eligible silver is privately owned metal stored in the vaults. It's not available for sale at current prices. Registered silver, on the other hand, has warrants attached and can be delivered against futures contracts. This is the available supply. Recent data shows registered inventory has dropped to approximately 39 million ounces. In a single day, we saw nearly 3 million ounces withdrawn from the registered category. And this is just the beginning of settling those 17 million ounces that were demanded. Do the math with me. If 39 million ounces are available and 17 million were just claimed, that leaves roughly 22 million ounces. At current withdrawal rates of 2 to 3 million ounces daily, we're looking at less than 2 weeks of available inventory. This explains the urgency we're seeing in the market. Now here's something critical to understand. When futures contracts are purchased, it shows up immediately on trading screens, but standing for delivery happens in the back office. The market impact is not felt until the metal physically leaves the vault and sellers realize they cannot replace it. We're in what I call the lag phase. The extraction has occurred, but the market hasn't fully priced in the inventory depletion. And if you're finding this information valuable, take a second right now and smash that like button. It tells YouTube to show this video to more people. Drop a comment below too. Tell me what you think about this situation. Are you watching the silver market? The engagement helps us tremendously. So who's involved in this massive metal movement? The delivery reports reveal something fascinating. On the issuer side, meaning those delivering the physical silver, Deutsche Bank appears prominently. They delivered over 3 million ounces. On the receiving end, the stoppers demanding physical delivery, we see major names like Citigroup and JP Morgan. Combined, these entities stopped over 4 million ounces. This isn't just trading, this is strategic positioning. JP Morgan holds one of the largest physical precious metals stockpiles globally. They didn't buy this silver to hedge a position. They bought it to control supply. They're seeing the same data we're analyzing. They know mining output isn't keeping pace with demand. They know the Chinese export restrictions are real and permanent. What we're witnessing is a shift in strategy. For years, JP Morgan maintained substantial short positions in silver. But shorting is how you suppress prices while accumulating. Once you've accumulated enough, the incentive structure flips entirely. If you hold hundreds of millions of ounces of physical metal, do you want prices at $70 or $200? The answer is obvious. This represents a fundamental change in market dynamics. The suppression phase appears to be ending. The accumulation phase may be complete. Now we're entering the revaluation phase where those who secured physical metal will benefit from rising prices. Let me share something with you that should concern every retail investor. While these institutional battles rage on, what's happening on Main Street? I've been monitoring inventory at major online precious metals dealers. The situation is alarming. Major dealers are showing extended delivery times stretching into March. That's 8 weeks from now. Products that typically ship within days are completely unavailable. And when you can find silver available for immediate delivery, premiums have exploded. Some dealers are charging 25 to 30% over spot prices. Think about what this means. Institutional buyers are securing silver at $71 per ounce in massive quantities. Meanwhile, retail investors trying to buy a single coin are paying $85 to $90. The wholesale market and retail market have completely disconnected. This premium expansion isn't just dealer greed, it's replacement cost. Dealers know what happened with those 17 million ounces. They know when they call wholesale suppliers to restock, either the phone won't be answered or prices will be significantly higher. They're pricing in the scarcity that institutional buying just created. Now let's look beyond the United States. Silver is a global commodity. To understand the full picture, we need to examine what's happening in Asia. The Shanghai Futures Exchange recently reported significant inventory movements. On the first trading day after the holiday period, Shanghai vaults lost approximately 46 tons of silver. That's roughly 1.5 million ounces in a single session. This confirms something crucial. The Chinese domestic market is responding to the new export restrictions. Industrial buyers, solar manufacturers, and electronics producers, they're all scrambling to secure supply. They know the export ban means incoming metal will be restricted. They're consuming their own stockpile at an accelerating rate. Let's combine the data points. New York is depleting at roughly 2.8 million ounces daily. Shanghai is depleting at approximately 1.5 million ounces daily. That's over 4 million ounces disappearing from visible stockpiles every day. Meanwhile, global mining production is around 2 million ounces per day. We're running a structural deficit of more than 2 million ounces daily. The world is consuming more than twice what it produces. This mathematics cannot sustain indefinitely. Something has to give. Either consumption must decrease or prices must increase to slow demand. This explains the institutional urgency. They're not looking at price charts, they're looking at inventory spreadsheets, and the spreadsheets are flashing red warning signals. There's a technical concept in commodity markets called backwardation. In normal conditions, future delivery prices trade higher than spot prices. This makes sense because storing and insuring metal costs money. But when markets go into backwardation, spot prices exceed future prices. This happens when buyers are saying they don't trust future delivery promises. They want metal in hand today and will pay a premium for immediate possession. We're seeing signs of backwardation in Asian markets. This is the heartbeat of a physical squeeze. The market is signaling that shortages exist at current price levels. Trust in the delivery mechanism is eroding. This same pattern preceded massive price increases in other metals like palladium and rhodium. Here's what makes this situation different from typical market moves. Western traders are analyzing technical patterns and chart formations. Eastern buyers are securing strategic technology inputs. China understands that silver isn't just a monetary metal. It's essential for solar panels, electronics, electric vehicles, and countless industrial applications. The West is trading paper contracts at $71, thinking about investment returns. The East is buying physical metal at premium prices because they know the cost of not having it far exceeds the current market price. Try running a gigafactory without silver. The production loss would dwarf any premium paid for the metal. This is a fundamental wealth transfer. Every ounce sold cheaply in Western markets gets refined and shipped to Eastern warehouses, where it will be consumed in industrial production. It will never return to the market. We're literally selling strategic resources at artificially suppressed prices. Now, some of you might be thinking, if this is such a crisis, why haven't the banks collapsed? Let's run the actual numbers. JP Morgan and Citi taking delivery of roughly 4 million ounces at $71 per ounce represents about $314 million in total. That sounds like a huge number, but consider JP Morgan holds over $1.6 trillion in Tier 1 capital. That $314 million represents approximately 0.02% of their safety buffer. To put it in perspective, that's like someone with $1 million in the bank spending $200. It doesn't dent their financial position at all. They have virtually unlimited dollar liquidity. They can print or borrow as much fiat currency as needed. But here's the critical insight. While the financial cost was negligible, the physical signal is deafening. If $300 million is pocket change for JP Morgan, why did they do this? Why drain the registered vaults? Why create potential retail panic? Why break the unspoken coordination with other banks? Because while they have infinite dollars, they know there's finite silver. They raided the market not because they had to spend the money, but because they had to secure the metal before it was gone. They know that next week, the same $300 million might only buy half as much silver. Next month, it might buy nothing at all. This proves the crisis isn't about bank solvency. It's about physical availability. The banks are converting worthless fiat currency they can create at will into the one asset that every technology company and industrial manufacturer is fighting over. They're swapping the fake asset for the real asset before the masses realize what's happening. What about Deutsche Bank's role? Why did they deliver 3 million ounces instead of holding? Deutsche Bank has struggled financially for years. They have massive derivative exposure and legal challenges. They're arguably the weakest major player in the precious metals market. It's likely Deutsche Bank was short silver and got caught in a price spike. They received a margin call but lacked the liquidity or willingness to maintain the position. So they delivered their physical inventory to close out the trade. They gave up their physical silver. Now they're flat out of the physical game entirely. Meanwhile, JP Morgan is long. This consolidates power. The precious metals market is centralizing into fewer hands. It used to be 5 major banks, then 3. Now it's essentially 2 dominant players, and they're hoarding physical metal for themselves. This consolidation is a signal. They're preparing for a new monetary paradigm. They're positioning for a world where tangible assets matter more than paper promises. They just took Deutsche Bank's seat at the table. Think about the strategic shift we're witnessing. For years, banks profited by shorting paper silver. They suppressed prices and collected fees from both sides of trades. But that game is ending. The Shanghai arbitrage killed it. Physical constraints are making paper suppression impossible. The new game is cornering physical supply. They use paper market volatility to scare retail investors into selling. Then they use their unlimited fiat currency to buy the physical bars that get dumped. It's a bait and switch on a global scale. They want you to think silver is risky and oversold. Meanwhile, they're backing up armored trucks to load 46 tons in a single day. Don't listen to what they say. Watch what they do. They're buying aggressively while telling everyone else the market is dangerous. So where does this leave us heading into the coming weeks? The holiday period is over. Full trading volume returns. Asian markets will react to this delivery data. When Chinese traders see that New York just extracted 17 million ounces, how do you think they'll respond? They'll interpret it as resource competition. The West is securing metal. This will likely trigger increased buying pressure in Shanghai. If they don't act, they fear Americans will take all available supply. We could see aggressive buying when Asian markets open, potentially creating price gaps. The institutional extraction has poured gasoline on an already volatile situation. The geopolitical dimension of silver supply is becoming impossible to ignore. Before we wrap up, I need you to do something important. Share this video. The information we're discussing, the delivery numbers, the institutional positioning, the retail blackout, none of this is being covered by mainstream financial media. They want the public uninformed while institutions drain the vaults. Share this on social media. Send it to friends who invest in precious metals. Help us break through the information blackout. Now let's talk about your position. If you're holding physical silver, you're actually aligned with JP Morgan. You're on the same side of the trade. But understand this, they want your silver too. As prices rise toward $80, $90, $100, you'll see marketing campaigns everywhere. Sell us your gold and silver, high prices, cash out now. They'll try to convince you to trade your hard asset for their paper fiat. Don't do it. They're buying because they know fiat currency is dying. Why would you trade the cure for the disease? Hold your position. Let the banks fight industrial users. Let them compete with China. You sit tight and watch your savings appreciate. The premiums at retail dealers, currently at $85 to $90, represent the real price. Don't sell for less than street prices. In fact, consider not selling at all until fundamental metrics like the gold to silver ratio signal we're near a market top. We're nowhere close to that point. Here's my final verdict on this 17 million ounce movement. This was a coordinated extraction. This was the day major banks realized the game fundamentally changed. They stopped pretending the market has unlimited liquidity. They took the metal and secured it in their own vaults. The COMEX registered inventory is critically low. Retail dealers are sold out. The East is hoarding. The West is extracting. And the price is still sitting at $72 for now. This is the calm before the revaluation storm. You now have the data. You have the framework to understand what's happening. All you need is patience and conviction. The metal is being removed from available supply. The physical squeeze is developing in real time. Welcome to the new paradigm. If this analysis helped you understand what's really happening in silver markets, make sure you're subscribed to Dark Economy. Hit that subscribe button, turn on notifications, and drop a comment below. Tell me what you think about this situation. Are you positioned for what's coming? Share this video with anyone who needs to understand these market dynamics. The establishment doesn't want this information spreading. That's exactly why we need to spread it. Thanks for watching Dark Economy. I'll see you in the next video where we'll continue following this developing story.